cover what are the different types of capital here. Okay, so before we move towards DFIs, development financial institutions, and NBFCs, we will try to cover the types of capital, and we will also talk about securities here, bonds and shares, etc. So first you give a heading, types of capital. What are the different types of capital? So first one, the same one that I have discussed, you can write authorized capital. Authorized capital. So what is this? This is a maximum capital which can be raised by a company. So right under that, maximum share capital that can be raised by a company. So there is a maximum share capital that can be raised by a company. So in case of RRB, I have told you in the amendment, it is a maximum 2000 crore, right? Now, is it possible that a company may be able to raise the maximum possible capital? It is not necessarily possible, right? So we have different other terms also, like issued capital, subscribed capital, called up capital, paid up capital, etc. So I hope you understood authorized capital. This is what the maximum fund that you can raise for a company A. Let's say company A, you are allowed to raise, let's say 100 crore. So there is a maximum you can raise for that particular company. Now second one, you write issued capital. Issued capital. Okay, see, you are allowed to raise this much, but the company may issue or offer 80 crore for the public. Okay, so when the company issue IPO, what is IPO, FPO, etc. we will discuss later in the capital market. So here, when the company is giving shares to the public, the company may offer up to 80 crore only. That is what issued capital. So just write there, it is a part of authorized capital. It is a part of authorized capital which is issued or offered to the public for subscription. Which is issued or offered to the public for subscription. So it is a part of authorized capital which is issued or offered to the public for subscription. So will it be more than authorized capital? Can issued capital be more than authorized capital?
No, sir.
No, it will be always less than or at the maximum equal to 1, right? It can they be same? Both can be same? Is it possible?
No, sir.
Why not? You are allowed to raise this much capital,
Yes.
and you can raise that much capital. What is the problem? You can issue that much also.
Yes, sir.
Yeah, like that. So issued capital, it can be less than or equal to the authorized capital. Exactly the same. Whatever is allowed, that much share you can issue. So out of this, something will be held by the owners. They will keep something with them, and then actual public means they can get the rest of the shares which are allowed, right? So issued capital can be less than or equal to the authorized capital. Third one, subscribed capital. Subscribed capital. Okay. See, you are issuing, let's say 80 crore or 100 crore. 100 crore is allowed, and let's say you are issuing 80 crore. It is not necessary that the public or the investor will subscribe 80 crore, right? So you may be able to raise 60 crore. That means 60 crore subscription may be there. Okay, that is what subscribed capital. It is a capital which is subscribed by the shareholders. You can write that. It is a part of issued capital. Subscribed capital is a part of issued capital which is subscribed or purchased by the investors. Which is subscribed or purchased by the investors. Or public. Investors or public. Okay. So can this be more than 2? Subscribed capital, can this be more than 2? The third one, can it be more than 2?
No.
No, that is not possible, right? Whatever the company is issuing, either that much or less than that only getting subscribed. So it will be, I can write it is less than or equal to second one. Okay. So because subscribed capital is part of issued capital only. So it will be less than or equal to 2. Now fourth one you write called up capital. Called up capital. Right under that, it is a part of subscribed capital which is demanded by the company from the investors, which is demanded by the company from the investors in bracket you can write the shareholders at any point of time.
Sir, please repeat.
It is a part of subscribed capital which is demanded by the company from investors at any point of time. It is a part of subscribed capital which is demanded by the company from the investors at any point of time. Next one, that is the most important one, paid up capital.
Sir,
Yeah.
sir, it is similar to buyback.
Which one?
Is it similar to buyback to called up capital? Sir?
It is the amount of share capital shareholders actually owe, but it is not paid.
Okay, sir.
Okay. Yeah. So paid up capital, it is a capital right under that. It is a capital or money which is actually paid by the shareholder. This is more important, okay? Paid up capital. It is the capital or money which is actually paid by shareholder. So these are the 5 different types of capital that you will see even in capital market class. Also we will be discussing about this. Authorized capital, this is what allowed. Issued capital, that much is company issued. Subscribed capital, that is what investors ready to buy. Called up capital, okay, that is what off but not actually paid. Paid up capital, shareholders actually paid for the share. So these are the 5 different capitals that have to be known to you. Now next topic is called up capital. It's actually the amount of share capital shareholders are promised to, it is part of subscribed capital only, but not paid completely. In case of paid up capital, it is actually paid. That is the main difference. Any amount of money that has been already paid by investor in exchange of share. So when you are getting the share, you are making the payment in case of paid up capital. The other one, you owe to the company but you have not paid, called up capital.
Okay, sir.
Okay, so that called up capital will be anyway more than paid up capital. But paid up capital is more important. When we discuss about company, when we discuss about share market and everything, paid up capital is more important. We will come to this, we will revisit this in capital market chapter. So next is securities. Securities, okay. So what are the securities? Different types. Bonds, right? Bonds and shares. What do you mean by securities? Any type of financial assets are securities. All type, you can write in bracket, all types of financial assets are securities. So it can be bonds, it can be shares. Now, why I'm discussing this is because I'm going to discuss about mutual fund, etc. ULIPs, insurance linked mutual funds, all these concepts. There I need to discuss about bonds, shares, the combination, different percentage, etc. That's why I'm quickly covering this part. So securities means bonds and shares. Now bonds, it can be government bonds, right? And corporates, right? Government bonds and corporates. So government bonds can be further divided into short term and long term. Short term and long term. What do you call for short term loans? Short term, it's actually loan only, loan given to government. Short term government bonds, what is the name?
Treasury bonds, sir.
Treasury bills, okay. So these are short term bonds. So why it is known as treasury bills? Because you actually have a claim over the treasury of the government. So short term government bonds, treasury bills. Long term dated securities. Dated securities. When we discuss about the concept of operation twist, which is part of current affair, I will discuss about dated securities later. What was RBI doing with dated securities in operation twist? We'll discuss that later. Now corporates, what are the bonds? What are corporate bonds? Debentures, first one. Okay. Then we discussed about commercial paper before. You remember where we discussed about commercial paper? Can anyone tell where we discussed about commercial paper?
Capital market.
No. Capital market we haven't taken.
The bank rate.
Yes, when we discussed about bank rate, right? Under various monetary policy measures, I've told you can actually, pledge the first class securities. First class securities means securities of the, this is security of the high net worth company. And I've told you high net worth companies, the securities is what? Commercial paper. Commercial bill also I've told you, that is a small companies. So commercial paper, I will come to this, okay? Now itself we'll discuss in detail. All these we will discuss. Commercial paper and what is there? A few different others are also there. Now this debenture, sometimes there will be some case of debenture which you can convert into shares. So initially you may take the debenture of the company, and if it is convertible debenture, later you can convert into share. If you find that is profitable, you can convert, okay? So initially you may be reluctant to take share, so you can go for debenture. So in case of debenture you get a fixed okay, I'll discuss it separately. Now let's finish it off, this division. So third one we can say convertible debentures. Okay, so these are bonds. Now when we discuss about shares, two types of shares are there. Normal, ordinary shares, right? Ordinary shares, that means the equity, normal, what we are discussing, equity shares, okay? Ordinary share means equity share. The other is preference share. I have already discussed about this when we discuss about Basel norms, preference share. And I've told you the difference also between ordinary share and preference share. In case of winding up of a company, if the assets of the company is sold, the preference shares will get the preference over the claim on the assets over the ordinary shareholder. But the profit which is divided, dividend will be limited to these people, not like what these people are getting in case of profit. Dividend will be limited, and in case of short profit, small profit, their claim will be met first, their dividend will be given first. So they will have a fixed dividend, actually a limited dividend. So that is why preference shares, they get a preferential claim over the company's assets. Okay, so we can discuss this in detail. So these are the securities: bonds, shares. So bonds can be government and private corporates. Short-term government bonds is what you call as treasury bills. Long-term government bonds is what you call as dated securities. Then apart from this, debentures, commercial paper, okay, convertible debentures, etc. There are then shares. When we discuss about mainly ordinary shares, preference shares also we'll have to discuss. So give a heading bonds. We'll start with bonds. These are negotiable, you can write, these are negotiable or tradable securities. These are negotiable or tradable securities issued against a loan. Issued against loans. Okay, what we have said, tradable securities issued against loans. Okay, they yield interest. So these are tradable securities issued against a loan. So what do you mean by this? When you hold a bond, let's suppose government bond or private bond, whatever it is, when you hold a government security, what does this mean? You are given loan to whom? You are given loan to government. Okay, so this government security is actually issued against the loan which you have given to government. So, and what is the return? Return is actually the interest. Okay, under that you can write treasury bill. First one, treasury bill. Treasury bill. These are short-term government bonds. These are short-term government bonds which are issued for four maturities. That means 4 different maturities. Okay, 4 maturities. So 14 days, 91 days, 182 days and 364 days. 1 year is the maximum. Now, is it given to general public? It is not sold to general public, only to financial institutions. Okay, only to financial institutions. So who is issuing this? It is issued by RBI and issued to financial institutions. What are financial institutions? That is what we are discussing from this chapter beginning, right? Banks, NBFCs, DFIs, etc. Okay, so if you hold this government security, you have a claim over the treasury because money will be given from the treasury, right? So there is a claim on the treasury. That's why treasury bill. Second, you write dated securities. Dated securities, long term.
So excuse me, sir.
Tell me, Ashwin.
Okay.
Okay, regulator and everything we'll discuss over there. Money, here dated securities. These are medium and long term government bonds. These are medium and long term government bonds. Okay, for example, you can write Kisan Vikas Patra, Kisan Vikas Patra, National Savings Certificate. So Kisan Vikas Patra is actually issued by post offices, okay, only to public. So these two are actually issued by the Kisan Vikas Patra and National Savings Certificates are issued by post office to public. So these are long-term government bonds. Now debentures. So debentures, this is coming under corporate bonds. Okay, so debentures, you write one line there. These are bonds issued by corporates. These are bonds issued by corporates to the public / investors, public or investors, against long-term loans. Against long-term loans. They yield interest. They yield interest. For example, debenture issued. So debenture means, let's say 1 lakh. Okay, so the company want to raise money, so issue debenture and long term, that is let's say 20 year and 10% interest, it will be written here. So if you are holding this debenture, you are supposed to get 10% interest from the company. So every year 10% have to be paid by the company. That means 10,000 will be paid by the company. Okay, and after 20 years what will happen? Company will pay back the entire amount. 1 lakh will be paid back by the company. Okay, now this debenture, it can be sold in stock exchange. I've told you this is tradable, right? It is not necessary that if you are a debenture holder, it is not necessary that you need to wait for 20 years. It is liquid only. It is tradable. Okay, so it can be traded. It can be sold in the stock exchange. Okay. Now next is commercial paper. We have already discussed, so quickly I will tell you, some new students are here. So commercial paper means I have discussed in the context of bank rate. So when I have discussed about bank rate, I have told you bank rate is the rate at which RBI provide money to the banks against the first class securities. So when I have discussed or explained about first class securities, I have told you commercial paper is the first class security. First class security means the security which is issued by high net worth companies, private companies, high net worth corporates. Okay, so here it will be like this. Let's say 25 lakh. This is a commercial paper. So it will be issued to, let's say, Bank SBI. Okay, and it will be issued at a discounted price. So the 25 lakh, this is a commercial paper. Okay, let me write it here. Is issued to SBI. What SBI will do? SBI will give money to the private company. Let's say this is TCS. Okay, so TCS issues commercial paper. TCS is a high net worth company. 25 lakh. This is for the short term working capital. Short term working capital of the company, and CP is the main source of short term working capital of the private company or the corporates. So it will be issued at a discount, means let's say SBI will pay, let's say 23 lakh, okay, or 22 lakh, whatever it is. So that is so this balance, this 2 lakh is actually the interest for the SBI here in this context. Now bank rate we have discussed is an entirely different concept. So this commercial paper, now SBI can pledge with RBI. Okay, so SBI can pledge with RBI, and under bank rate SBI can get money from RBI under bank rate. So RBI can give around 24 lakhs etc. It will be anyway more than this, because bank rate will be so anyway more than this interest rate. So it will be, because this is 25 lakh, so RBI will give around 24 lakh based on the bank rate. So bank rate will be anyway less than this interest rate, no? So I hope this is clear. So this part we have already discussed. So this is what commercial paper. Same thing is only commercial bill, but here we are talking about high net worth companies. Commercial bill in the case of small companies. Are we okay?
Excuse me, sir. Sir, what is CODs, certificate of deposits?
Certificate of deposits. I don't remember actually. I don't remember by. Can anyone clarify this?
Sir, it is like an instrument, like CP is instrument in capital market. Same like COD is there. Or when top rated companies.
It is related to
take the loans. It is a money market instrument. It is issued by a scheduled commercial bank. It is just like an FD maybe.
It's like you keep a fixed deposit, and this paper was issued, and you can submit it to a broker, and you can go for option selling or something. Is it like that?
Yes, sir. And it is tradable. It is tradable. FD is a non-tradable instrument, but this is tradable.
Okay. I exactly don't know what is that. So.
Sir, I have a doubt.
Tell me.
Are commercial paper open for public?
Commercial paper? No. This is this is from banks.
Okay, sir.
Debentures are for public. Commercial papers are actually bought by banks. It is offered to banks at a discount.
Okay, sir.
Okay. Now this debenture. Okay. See here. This, instead of this debenture, if it is a convertible debenture, what is the advantage for this company is, if it is convertible debenture, after some time this debenture holder can convert this into shares. So 1 lakh worth share will be given in the company. So in the beginning of the company, the investor, the person who's holding the debenture, he might be apprehensive in investing in the company. He is not sure about the success of the company. So he take debenture. This is very less risky because you are getting the fixed interest and there is no problem. So later, if the company is doing good, it could be converted to shares of the company. So that is what convertible debentures. So just write convertible debentures. it can be converted to share, or you can write in this way: these are special type of debentures. These are special type of debentures that can be partially or wholly converted into shares. For example, if you want from this 50,000, you can convert to share and you can maintain the balance of 15,000. In that is also possible. Partially or wholly converted into share within a specified time period. Okay. So what do you think here? If it is debenture, I have told you 10%. I have randomly taken this number. So if the same company, let's say this is TCS, okay, if the same company is offering a convertible debenture, what do you think will be the interest? Will it be more than 10% or less than 10%?
So less than 10%.
Less than 10%, because you are giving some flexibility. So whenever you are giving some flexibility, you have to compromise on something, right? So the interest will be slightly less than the normal debenture in case of convertible debenture, because you have been given an option to convert it. Okay, so that's about bonds. Now shares. Right, the first one, preference shares. Normal share, ordinary share, I hope everybody know. It is the equity, that is a normal shareholding, whatever is the actual investor investing. Preference share is actually not in India. It is not common in India. It is very rare in India. Only few companies, you can even count in with your hands. So very few companies are offering preference share. So we don't want to get into what is preference share, etc. in detail. You just need to know what is this, okay? So just write preference share. These are securities issued by corporates. These are securities issued by corporates which confers limited ownership rights. Limited ownership rights to their owners. Limited ownership rights to their owners. That is, usually there won't be any voting rights, okay? So usually no voting rights. In exceptional cases, voting rights may be given. So you can write usually no voting rights and limited dividend. So I've told you dividend means after the corporate income tax. So whatever if this is a total profit, there is a corporate income tax. So let's say 30% is paid. Okay, let's say 10 lakh is the profit. So 30% is gone, balance 7 lakh is there. So this 7 lakh will be distributed. Let's say 1 lakh shareholders are there. So dividend is actually 7 rupee. Okay. Or there is a concept of undistributed profit also. You may distribute 5 lakh and you may reinvest 2 lakh in the company. This is undistributed profit. In that context, dividend will become 5. So this dividend will be for the main shareholder. But in case of preference shareholder, limited dividend will be given, not complete dividend will be given. Okay. So if there is no profit, there is no dividend. If there is limited profit, they will get dividend first than the actual shareholder. But if there is a big profit, they will get limited dividend. You got it? There is no profit, no dividend. Limited profit, they get dividend. Okay, they get only after that. If something is left out, the actual shareholder will get. Then more profit.
Sir, if there is a loss condition, does preference shareholder bear it?
Preference shareholder?
Bear it or not?
Yeah, they have to bear it. They will have to absorb the loss.
Okay.
Okay. See, for example, let's suppose there's a company A. Company A is having a burden of, let's say, 100 crore. Okay. So this 100 crore burden may be, there will be creditors. Creditors means borrowers. The from whom you have taken loans, right? It could be debenture holder, it could be from banks you might have borrowed. So creditor, and then preference shareholders, they have also invested, shareholders also invested. But when the assets of the company sold off, you got 100 crore only. And if this creditor, for the creditor itself, you need to pay 100 crore. Okay, so first claim will be for creditors. This entire 100 crore will be paid to the creditor. In that context, preference shareholder have to sacrifice, shareholder will also have to sacrifice. But if when the company is sold off, 110 crore is available. So for example, their debt is 100 crore, preference shareholder invested 30 crore, shareholder invested let's say 70 crore. So what you get is 110 crore. So first, out of this 110 crore, 100 crore will be settled. Then the balance 10 crore will be for the preference shareholder. Even then they have to suffer a loss of 20 crore. But what is the advantage here? They have a preference over the ordinary shareholder, the equity, normal owner. So they have a preference over the shareholder but not over the creditor. So first claim will be by these people, second claim will be by these people. Shareholder will have the final claim over the assets of the company in case of liquidation. Okay? Anjali?
Okay, sir.
Yeah. So we were talking about what? Limited dividend. I hope you understood. So they yield a fixed dividend mostly. Okay. So just write one more line. They have preference over shareholders in distribution of dividend. They have preference over shareholders in distribution of dividend as well as over the assets of the company during winding up, or in bracket you can write liquidation, during liquidation of the company. So they have preference over shareholders in distribution of dividends as well as over assets of the company during winding up. So if you talk about shareholder and preference shareholder and creditor, among those, who is having the first preference? Who is having the first preference?
Creditors.
Creditors have the first preference during wind up of the company. Second, shareholder. Third, okay. They have preference over shareholders in distribution of dividends. So they will get this dividends first, distribution of dividends, as well as over assets of the company. So over dividends and over assets of the company during winding up. So preference shareholders have preference. Okay. See, these two are entirely different entities. These two are different products. Share, ordinary share and preference share. It is not that share issued to some preferential person or important person are preference shares. No, these two are entirely different products. Okay, like phone and mobile phone and iPad. These two are different products. Similarly, preference share and the ordinary share, these two are different product. It is not that the ordinary share issued for a powerful person or preferential person is preference share. That is different. That's not the case. Both are different things. Okay. So that's about preference share. Yeah. So that's about securities.
So why they are not common in India?
But even in the future discussion in this module, actually, preference share is not important. We just need to know what is bond and what is share. In which context I have discussed this, basically because we are going to discuss about mutual funds. Mutual funds is all about investment in bonds and shares in different percentage. Okay, like when we discussed about NPS also, I have told you NPS fund will be divided in mutual fund, and that will be invested in shares and bonds in a certain percentage, like 40, 60%, etc. So here also we are not talking about preference share. In case if it is asked, only from exam point of view I have discussed. I also don't know exactly, how is it offered, the mechanism or procedure. We don't want to get into that. We'll stick to this exam. Okay, anything else? We'll stop here today.
Sir, please explain commercial papers again.
Commercial paper means, let's suppose the company TCS. Okay, so for short-term working capital is required. So commercial paper is actually the most important source for the short-term working capital of any company. So TCS issue the commercial paper. It will be like 25 lakh. Okay, it will issue to the bank, let's say SBI. So SBI will provide the short-term working capital. So in the commercial paper, this is what you call as a face value, 25 lakh. But you won't get the entire face value. You will be giving it to SBI at a small discount. So SBI will give you, let's say 23 lakh. This is what discount. So what is the return for SBI? SBI will get this 2 lakh, the difference. And why TCS has issued this? This is for short term, this is 1 year. Short term working capital. Okay. So TCS is a very high net worth company, big company. So this is CP. If it is small company, CB, commercial bill. Okay.
So that part when RBI.
RBI, that is different context. I've just went for a recap of one thing we have already discussed. I will do that later for you. I'll give you the video for that. Because that is connected to another concept, bank rate. For that, we need another discussion actually.
Okay, sir.
Okay. Can we stop here?
So one question.
Okay. Tell me.
So are bonds free from all kinds of market fluctuations?
Bonds are free from market fluctuation because anyway you are supposed to get the face value.